Welcome to NTD Business. I'm Don Ma. Just a quick overview of markets today. Stocks are drifting on Monday since a big rally for Wall Street hit its first roadblock in 6 weeks. Trading was mostly quiet in financial markets around the world as the fundamental question remains the same and unanswered for investors, which is, will the economy be able to avoid a painful recession after central banks around the world hiked interest rates at a blistering pace? Adding to the uncertainty was a short-lived armed rebellion in Russia over the weekend. The war in Ukraine has already helped push upward on inflation around the world, but investors mostly looked past the brief mutiny by mercenary soldiers. For markets, the threat of a power vacuum in a nuclear military power holds obvious risks, but the most extreme of which are near impossible to price, and so most asset managers hold and wait. This upcoming week doesn't have many economic or earnings reports that can help answer the question of whether we can avoid a recession. More emphasis will be on June's inflation data, which will arrive next month. Also upcoming is the next month's jobs report. For now, traders are betting those reports will push the Fed to raise rates by 0.25 percentage point at its next meeting, according to the CME Fed tool. But much of Wall Street expects a hike next month to be the final one of the cycle. On the other hand, the Fed has suggested it could raise rates twice more. The White House on Monday doled out $42 billion among the nation's 50 states and U.S. territories to make access to high-speed broadband internet universal by 2030, with every state receiving a minimum of $107 million. This funding under the Broadband Equity Access and Development Program was authorized by the $1 trillion 2021 infrastructure law Biden championed. Texas and California, which are two of the most populous U.S. states, it tops the funding list at $3.1 billion and $1.9 billion, respectively. Here's what Biden said earlier today.
What we're doing is, as I said, not unlike what Franklin Delano Roosevelt did. We brought electricity to nearly every American home and farm in our nation. Today, Kamala and I are making an equally historic investment to connect everyone in America to high-speed internet by an affordable high-speed internet by 2030. It's the biggest investment in high-speed internet ever.
Broadband companies such as Verizon, Comcast, Charter Communications, and AT&T have been reluctant to provide access to low-population rural communities because the investments are expensive and the regions do not offer a lot of subscribers. The lack of broadband access drew attention during COVID-19 shutdowns that forced students into online schooling. States are expected to submit initial plans later this year that will unlock 20% of the funding. And once the plans are finalized, which could take to 2025, the government will release the remaining money. Now, what if treating obesity could be easy as popping an effective pill? That's a notion that has long fueled hope for many of the more than 40% of Americans who are considered obese. And soon, it could become a reality. Drug maker Novo Nordisk plans to ask the U.S. Food and Drug Administration to approve the pills later this year, but timing of a market launch is to be determined, according to the medical director at Novo Nordisk. The company on Sunday said a late-stage trial found that a high-dose oral version of its drug semaglutide helped overweight or obese adults lose 15% of their body weight, which is in line with recent results for other experimental obesity pills. Shares of Novo Nordisk have more than doubled in the past 3 years. By some estimates, the obesity treatment market could grow to more than $100 billion in size in the coming years. There have been other weight loss pills on the market, but none that achieve the substantial reduction seen with injected drugs. And apparently Pfizer is also trying to race to catch up with Novo Nordisk in the obesity treatment market. But on Monday, Pfizer said it's scrapping its once-a-day experimental obesity pill because of concerns about liver safety. But it will still continue developing its other obesity pill, the twice-daily treatment. Pfizer CEO Albert Bourla has said that an obesity pill could eventually be a $10 billion a year product for Pfizer. And arguably the most forecasted economic downturn in U.S. history has stubbornly refused to appear. Why? And here to talk to me about how we have avoided a recession so far here in the U.S., Chief Strategist at Mill Street Research, Sam Burns. We've been talking about a recession since last year. so far it seems like we haven't actually encountered one. Why do you think that is?
Yeah, you're right. It's been a very widespread assumption that from late last year that we'd be in recession any time now, and certainly by now, and by according to most all the data, we're not. I think the main reason that people have gotten it wrong is they've been focused heavily on the Fed and monetary policy and assuming that all the tightening that they've done would cause a recession by now. But I think what they've missed or overlooked in some ways is fiscal policy. I think that's really the difference this cycle versus a lot of previous cycles where fiscal policy is actually quite supportive right now and helping to offset the monetary tightening that we've seen from the Fed. And that's, I think, the main reason why we're not in recession now when we might otherwise have been.
And to your point, I think one of the biggest liquidity injections into the economy was the stimulus checks during the pandemic. And it takes a while for that money to filter itself out of the economy, because if one person spends money, it doesn't disappear. It's transferred to another person. So it takes some time. So do you think this will eventually filter out? The economy will eventually digest this amount of liquidity?
No, I think you're right. There's definitely been a long sort of lag impact from all the stimulus that was due to COVID. But then the other thing that's happened is we've basically gotten kind of a second stage of it starting last year with all the infrastructure and kind of spending bills and things that the Congress passed. The infrastructure law, the CHIPS Act, the Inflation Reduction Act. Those are all pretty large bills that involve a lot of spending and investment and incentives for companies. And we're starting to now see that kind of filter through into the economy and a lot of companies. So you had the big first wave from COVID, it's just starting to slow down. And then you had a kind of a second wave driven less to consumers and more to businesses from these kind of infrastructure and stimulus related programs that will probably last for a while longer because they have kind of longer term impacts. So I think that's what we've had is we've had a second stage come along now that's also helping to support a lot of corporate activity and investment.
I would like to just point out, I mean, I'm not saying we're not going to have a recession, but if we do, this may be arguably the most forecasted, most expected recession in all of history. But that point aside, manufacturing is sort of in contraction right now, and meanwhile, the services side of the economy is not. I think that potentially is also holding up the economy from going into recession. What do you think?
No, you're right. There was a big shift from kind of people buying goods essentially, during and after COVID when they couldn't go out and do things, use a lot of services. And now it's gone the other way where the spending on services has really jumped up. A lot of travel, entertainment, going out, all those kinds of things are really seeing pretty strong spending. And I see that when I look at analyst earnings activity for a lot of the companies that are involved in travel and entertainment and things like that. So there's definitely a lot of that going on right now, people wanting to go out and do things that they couldn't do the last couple of years. So from the consumer side, that's very much what's driving spending right now. And the fact that the labor market is still strong and wages are still pretty strong means that there is money available to do that in the economy. So you have a strong job market and you have some of this kind of corporate infrastructure-led spending. I think those two things are really helping offset the impact of higher rates from the Fed.
Yeah, on that point, I mean, do you think this recession is sort of delayed or perhaps it can be avoided entirely? Because the interest rate hikes from the Fed, they'll still have an impact on the economy. I mean, around 5% Fed funds rate, that's higher than the GDP that we're seeing in the U.S. economy. So there could be some slowing of the economy. I just want to get your thoughts. Are we avoiding this recession or is it just being delayed?
I mean, I think it's definitely being delayed. You might have some situation where next year, say, you get a quarter or two of negative growth, which some people would call technically a recession. My guess is though that it will not be a severe or extended recession like we've seen in some cases in the past because of these offsetting kind of fiscal supports and kind of the tight labor market, which I think will last a little while longer. So I think there's definitely reason to expect that we might have slow growth. Maybe there's a quarter or two of negative growth in there, but not a traditional kind of extended widespread recession, for a while longer. Yes, eventually, of course, we'll have a recession sometime, but I think it may get delayed for quite a while.
And if it does come, in fact, then you're seeing it as a rather mild one?
So far, yeah, I think a lot depends on kind of how fiscal policy evolves, going into next year. A lot of what we're seeing now is kind of the effects of things that have happened, legislation that's been passed and things like that. I think if the Fed does start to ease rates next year, realizing that as inflation comes down, that a 5% Fed funds rate will probably be too high next year, that could also help, kind of give a little boost and offset some of the tightness in monetary policy to keep the recession from either happening or from being particularly bad. So I think there's definitely levers that can be pulled. I think the prospects of more fiscal stimulus, given the divided Congress right now, are probably much lower now. So I wouldn't expect a lot more in that regard. But a lot of what's already happened will have longer term impacts over the next couple of years.
And on your point of rate cuts from the Fed, I think the stock market is really hoping for that. And the rally that we've seen in the past few weeks from the stock market, I think that has sort of boosted consumer sentiment because they're seeing that maybe things are good and they want to keep spending, and that's perhaps one other reason that has held the economy up. What are your thoughts?
Yeah, there's definitely, to some degree, a bit of a wealth effect from stock prices going up and people's portfolios doing better. And yeah, there's sort of a psychological effect of seeing the stock prices go up and earnings holding up well. I think there's definitely a positive impact from that. It's a little bit more indirect than some of the other things, but I think that it is. I think people on the street still see jobs available. Wages are good, and the stock market's doing fairly well, even despite high mortgage rates and higher interest rates. And I think that it's making people think, well, maybe things aren't so bad, and we can keep going. If the labor market does start to weaken, and companies start to try to cut costs, things like that, like I said, I don't see that happening right away, but that could certainly happen sometime next year, particularly if interest rates stay high and companies get worried, or something else happens, say overseas. If China really goes into severe recession, or Europe slows down a lot, or something else happens that would cause global activity to really weaken, that could filter into the U.S. economy as well. And then again, if fiscal policy, Congress does things that slow things down, that could also have an impact next year.
Just one final thought. Do you think the amount of debt that the U.S. has now, as it increases over time, that will put more downward pressure on the economy in terms of contraction?
I don't think the federal debt will. I think in general that's more independent of what the economy is doing in some sense. And I think to some degree, when the federal government spends more money and runs deficits, that it's actually stimulative to the economy. Now, eventually, yeah, you can get too much debt and it becomes a problem. I don't think we're really there yet. It's more on the corporate or state and local governments or consumer side that you would have a concern about debt really slowing the economy down. I think right now, in general, corporate and consumer levels are okay. They're not at extreme levels at this point. So I think that the debt issue is not a concern at the moment. But consumer credit certainly has risen a lot, and the rates on those have gone up. And mortgage debt could be a concern as rates have risen. So those are things that could certainly slow things down as we go into next year. I don't think it's to the point of causing a crisis or causing a recession by itself, but that would be an additional impact if other things slowed down.
The reason I ask, because just very quickly, because if the debt keeps going up, the interest payments on that debt will also go up, and that will divert the budget where it would have went into infrastructure or things like that, and there would be less investment in the economy itself because of the interest payment.
That's certainly possible. It all depends on how Congress chooses to do their budget. It doesn't require that they cut infrastructure or other spending, but they might do that as a result. And of course, there's always the question of what the Fed does. If the Federal Reserve, buys some of the bonds that have been issued, then essentially the interest payments on those bonds, kind of go back to the Treasury anyway. They don't really factor into the overall fiscal kind of profile. So there's two sides of that. There's the central bank, and then there's what the Treasury is doing in Congress. And I think those two things kind of can balance each other out depending on what the policymakers decide to do. So if they really want to tighten, they can, and cut spending, raise interest rates. Fed stops buying bonds. That would potentially slow things down. But even those interest payments that come from the Treasury, those are going to consumers. Those are going to people, and they give them more money to spend. So there is a stimulative effect to that as well, to some degree, that often gets overlooked.
All right, thank you for talking with me today, Sam.
My pleasure.